Hi, my name is Monil Kapadia from Kapadia CPA Professional Corporation. Today we are going to talk about what expenses a business can claim and how to save and plan the taxes. The very first and the most common expense is home office, which includes the mortgage interest or rent, property taxes, maintenance fees, any utilities, repairs, or home insurance can be claimed against home office. The way this will work is you can claim a proportion of these expenses against your business income, and to calculate the proportion, you have to divide the home office space that you're using divided by total home space. This will give you the proportion of these expenses which you can put against your business income. Next expense is vehicle expense. If you own the vehicle, then you can claim CCA depreciation. If you're leasing, lease payments, fuel, repairs, maintenance, annual registration, and parking and toll charges can be claimed against vehicle expenses. Now, this also works as a proportion to how much kilometer you're driven for your business versus how much kilometers you're driven in total. So say for example, if you're driven 20,000 kilometers in a year, of which 5,000 kilometers are for business use, then 25% of this expenses you can put against your business income. One important point, CRA wants you to maintain a mileage log, which logs your daily trips and which divides the trips between business and personal kilometers. So if an audit happens, you have to provide a business mileage log to the CRA. Next expense we're talking is meals and entertainment. So if you're taken any meal, a business meal, or if you're taken any client for any kind of entertainment, then 50% of that expense can be claimed against business income. There are cases where you can claim 100% of that expense against the business income. Say for example, if you've done any staff event or parties, then you can put the whole expense against the income. The next big head is the capital cost allowance or depreciation. So for example, if you're using any asset in your business, you can claim depreciation. The rates for 2020 year are as below. If it is a passenger vehicle, you can claim 30%. If it is an electric vehicle, there is an incentive where you can claim complete 100% in 1 year for the use of the vehicle to the maximum of $55,000. So say for example, you bought a $55,000 electric vehicle. In the same year, you can depreciate all 100% and claim against your income. A very good incentive and a good tool to be utilized to save your taxes. 20% is on furniture and fixture and 55% on computer and laptops. Now, if you have newly bought any asset in the very first year, you can claim half of this percentage because it is bought middle of the year. In the second year, you can claim it fully as per this rates on the depreciating or the declining value. If you're renting the office, then any office rent that you pay can be expensed out. If it is for advertising and promotion through Canadian broadcasters, or 100% if it is online. If you have built up a website or done any kind of digital marketing, you can always expense that out. Any kind of travel, if it is public, or any kind of air tickets and hotel costs, if the business or the travel is associated to your business or any kind of training that you're taken to increase that business, can be expensed out completely. If you're paying salary to yourself or to any employee, any expense related to that salary also, including the CPP and EI portion from employer or any kind of other benefits, can be claimed as expenses. If you're taking any insurance, general liability or property insurance or life insurance in certain cases can also be claimed as expenses. Below shows certain miscellaneous expenses that you can claim: office stationery and supplies, bank charges, if you're taking line of credit or bank loan, interest on that, legal and professional fees. So if you're paying an accountant to file your tax return, can also be expensed out. Business telephone, internet, any kind of business training expenses or bad debts can also be written off against your business income. Now, we talked about all the expenses. Let's talk about how to plan and manage your taxes or manage your income. The very first term that you will come across is tax splitting. Now, tax splitting means when you split your income with your family members to save your personal taxes. Be aware that there are rules for splitting the income, which is called tax on split income. So you need to make sure what you're doing is absolutely correct, because if government says this was an unreasonable, then they will charge the highest tax rate on the split income. So please reach out to your professional accountant to make sure that the splitting is done within the laws, within the rules. There is a proper documentation and proper planning before you do the splitting. Now let's look at an example. How does this work and how does this save your taxes? Say, for example, your corporation earned $100,000 after taxes and expenses, and this is issued to you as dividend. When it is issued as to a single taxpayer, he will end up paying around $17,000 in personal tax. When that income is split between spouse, then each spouse gets $50,000 and they end up paying around $3,700 each in the taxes, summing up to $7,400. So for the same $100,000 dividend, you're now paying $17,000 versus $7,000. So you're paying $10,000 less in taxes only by splitting the income. Again, there are rules on tax of split income. So make sure you know what you're doing and you're documenting it properly. Let's talk about the tax deferrals now. So in our previous example, we saw you made $100,000 after taxes and you took out the whole amount and issued a dividend to yourself. In reality, you're not required to take out the whole amount and issue a dividend or salary to yourself. Say, for example, if you're making much more in your corporation than your personal needs, then you only take out a portion of that to pay for your bills and mortgages and keep the remaining into your corporation under the retained earning to optimize the withdrawals, and you can then invest that money through your corporation in passive income, whether it is shares or real estate property. Now, just to make sure that there are rules for investment in passive income, there is a different tax rate that is applicable. So you need to understand what you are doing is absolutely correct. So again, reach out to your accountant to make sure that you have specific or room available to do this investment through your corporation. So let's take an example about how tax deferral works. In the example when there is no deferral, here you have made $200,000 in income. We have assumed $25,000 in expenses, so net is $175. The very first tax that you will pay is the corporate tax. We have assumed it to be 12.2% based on 2020 tax rate in Ontario. So you will end up paying $21,000 in taxes. Net income after taxes, whatever is left, the whole amount, you're taking it out as dividend, no deferred. So in this case, you will end up paying around $38,000 in personal taxes. In total, both corporate and personal put together, you paid $59,000 in taxes. Now let's look, how does it look when we defer the income? So the same income, you will end up paying around $21,000 in corporate taxes. Here, instead of taking the whole $153,000, the taxpayer needs only $75,000 to pay off his bills and mortgages. So he keeps the remaining $79,000 in the corporation in retained earning, and this can be invested into passive income. So here on the $75,000, he will end up paying around $9,000 in personal taxes. In total, he paid $30,000. So we see a net difference of $29,000 when he deferred the income. So very wonderful tool to defer the taxes into the future years so that you can save today, invest today, and then you can reap benefits for that by cumulative investing throughout the years. So if you're a new business or if you're planning to buy a new business, we also do small business loans, which is called CSBFL or Canadian Small Business Loans. This is a government guaranteed loan and you can get it through any banks by providing business plan and projections. So if you're planning to get a loan, we can help you do the business plans and projections and connect it with your bank and can get a loan for your small businesses. Just a brief about our services. We do incorporation, whether it is business or contractor. We also do provincial and financial, the federal corporation. We file for personal and corporate taxes, including the tax planning. We also do the accounting and bookkeeping. If you're planning to buy a franchise, we do an evaluation and a due diligence to make sure the business is viable for you. If you wanted to have a business loan, we do the plans and projections. In case if you have CRA audits or review letters, we respond to them. Just a brief about our team. It's me and my spouse, Hita Kapadia, who is a partner in the firm. We have Ayushi, who is chartered accountant from India and senior accountant. Shriyal and Prashant are on-line accountants. So thank you so much for watching these videos. Please subscribe to my channel because I'll be doing a sequence of videos and will help you understand how the tax system works and how you can plan and save your taxes. Thank you so much for watching and take care.